Welcome to the weekend edition of the Fear and Greed Business Headlines, the week that was, a wrap of the biggest stories over the past 7 days. I'm Sean Aylmer. Well, it was a week of politics, floods and corporate takeovers and intrigue. Let's start with Canberra. It was the week in which JobKeeper ended. Federal Treasury Secretary Stephen Kennedy said the finish of the $90 billion scheme would hurt some employees and businesses, particularly small businesses. He estimated that up to 150,000 people could end up without work, and 1.1 million employees would stop getting the payment. Overall, the economy has outperformed expectations, though the unemployment rate needs to get down to 4.5% or lower before you'll start seeing higher wages. All this good news means the federal budget is likely to come in at around $150 billion this year, not the $200 billion forecast last October. That's because iron ore prices are 3 times the level of the budget forecasts, and the surprisingly low unemployment rate means the government isn't making as many welfare payments. The government also said it was rethinking the $4 billion job-making hiring credit program. Not a bad idea, given that this is the one that was supposed to create 450,000 jobs, but so far, only 521 new positions have been filled. The COVID-19 vaccine rollout got a kick along this week, though the floods in New South Wales slowed distribution in that state. The Therapeutic Goods Administration approved the first batches of the CSL-made AstraZeneca jab, and Federal Health Minister Greg Hunt said around 500,000 doses will go out each week. There were 312,000 vaccinations on Tuesday. That was a record. State governments across the country also continued removing restrictions. In Victoria, football stadiums can now be at 75% capacity and offices can be at 100%. In New South Wales, most restrictions on the size of gatherings were lifted and masks will no longer be mandatory. Life is slowly, very slowly, getting back to normal. Parts of New South Wales were declared a natural disaster this week amid widespread flooding on the central, mid and north coast of the state and in Sydney. Thousands of Sydney residents were evacuated and the number of claims will be counted in the tens of thousands. According to the Bureau of Meteorology, it was a 1 in 50-year weather event. There was plenty of international news around this week. Senior officials from the US and China met in Alaska. It descended into name-calling and really didn't go so well. Later in the week, the head of NATO came out and said China should stop bullying Australia. China retaliated by criticising Canberra for its human rights abuses. There's just a sense of Australia becoming the meat in the sandwich in this one. Staying on the same topic, China and Russia, 2 nations which have never really had close historical ties, said they would bandy together to become less reliant on the US and oppose Western aggression. Tokyo Olympic officials said the Games would be held this year without overseas spectators. The governor of the Turkish central bank lifted interest rates and promptly lost his job. And Israel went to the polls the 4th time in 2 years, and so far, neither Prime Minister Benjamin Netanyahu nor the opposition are able to form a government. On to markets, it was the 1-year anniversary of the COVID-19 stock market crash. Since that time, the S&P ASX 200 is up 48%, led by the technology stocks. The best performer has been gaming group PointsBet Holdings, up 1,100%, on the back of deregulation of the market in the US, where PointsBet operates. Buy Now, Pay Later groups Afterpay and Zipco have been the other 2 great performers over the past year. Utility stocks such as AGL Energy and consumer staples like Woolworths and Coles have been among the worst performing stocks. Overall, it was a relatively quiet week for share markets, particularly given the turmoil of the past year. In the US, Wall Street was waiting on details of the rollout of the $1.9 trillion stimulus package, and also traders fear that future spending may come alongside higher tax rates. In Europe, trading was dominated by fears that the latest wave of COVID-19 cases could hamper the economic recovery. Germany, France and Italy all announced new restrictions during the week as case numbers rose. Locally, the market didn't have much direction. The rollout of the COVID-19 vaccine will increasingly be a focus for traders. But that doesn't mean there wasn't plenty of corporate news around this week. Let's start with AMP. Its chief executive, Francesco De Ferrari, was expected to resign, ending a controversial 2-year reign running the iconic company. AMP's mantle as one of the country's great companies has well and truly been lost, and it's up to the board to somehow find someone to set a sustainable course for the business. Crown Resorts received an $8 billion bid from private equity giant Blackstone Capital. The group already owns nearly 10% of Crown, and the kingmaker in the deal will be James Packer, who owns 37% of the gaming group. Mr. Packer indicated he'll vote the way the board recommends. Crown is struggling to get its gaming licence in New South Wales, following an inquiry in that state. And this week, the Victorian Royal Commission into Crown kicked off. It's a very busy time for Chair Helen Coonan. Telstra said it will undertake a major restructure which will split the company into four. The telco's 1.3 million shareholders will get a stake in the holding company, which sits across the top. The group will split into an infrastructure business, a towers business, a product and services division, including mobile, and an international business. The group hopes it will unlock value and in the future, it will make it easier to break off parts of the business. Westpac said it was considering selling its New Zealand subsidiary after a spat with the central bank of that country. The Reserve Bank of New Zealand wants Westpac New Zealand to hold more capital, saying it had experienced ongoing compliance issues with the group. Westpac and its predecessors have operated in New Zealand for 160 years. Supermarket giant Coles, the nation's 12th largest user of electricity, said it will deliver net zero greenhouse gas emissions by 2050, and within 5 years it will power its entire company with 100% renewable electricity, bringing it into line with its competitors. AGL Energy is pushing ahead with plans for a massive battery to be installed at its Loy Yang power station in Victoria. Resolute Mining was told by the Ghanaian Minerals Commission that its lease for the Bibiani gold mine had been terminated. Full stop. Resolute's share price fell 26%, and the decision demonstrates, starkly, the sovereign risk involved in mining in faraway places. And there were some decent earnings results this week from Sigma Pharmaceutical, Brickworks and WH Soul Pattinson's, while Coal Group New Hope said it suffered a loss for the half year. Premier Investments, which owns Smiggle, Peter Alexander, Just Jeans and Dotty, among others, said its half-year profit was more than its full-year profit in 2020, but it has no plans to give back the $20 million in government subsidies received during the period. It was a crazy week for Airtasker and Freedom Foods for very different reasons. Airtasker listed this week. If you got in on the float, you got shares for 65 cents. On debut, it jumped 65% and then kept rising, eventually reaching 170% above its issue price in just 3 days. Basically, it was boosted by social media chatter. Then later in the week, it tumbled 23%. Crazy. Freedom Foods returned to the ASX after being suspended for 9 months. It fell 91%. And the company went from being valued at $800 million to just $76 million. Freedom makes dairy products and cereals and was suspended in June last year after having to write off $60 million in out-of-date products. Accounting irregularities were also alleged. Now I get to the point in the program where I go through the biggest story of the week, the sleeper story, the most remarkable story and my favourite story. The biggest news story of the week was the allegations of rape inside a ministerial office, lewd behaviour in Parliament House, and the Prime Minister's response. It isn't overstating it to say this could be a game changer in terms of Scott Morrison and the Coalition's election chances next year. At the heart of the story is disturbing allegations by former Lib staffer Brittany Higgins that she was raped by another staffer. It's evolved to be about the culture and behaviour within Parliament House. This week it emerged that a Coalition staffer was sacked for performing lewd acts on a female MP's desk. Ms Higgins, for her troubles, has been lambasted, something she doesn't deserve. She's shone a light on atrocious behaviour, criminal behaviour. Mr Morrison's response has been tepid at best. He talked about quotas for women in the Liberal Party and then backed away. He will move on Attorney General Christian Porter, who is subject to rape allegations which he denies, and Defence Minister Linda Reynolds. But he has looked weak. How this plays out in polling will be very, very interesting. The sleeper story of the week was around imports of electric vehicles. There was an almost 500% increase in electric vehicles coming into Australia during February, pushing total vehicle imports to their highest level in 2 years. There was also a doubling of hybrid vehicle imports. I see Teslas more and more driving around the streets, but these figures confirm the shift is on. The most remarkable story is a no-brainer. How can a ship get stuck in the Suez Canal? Well, one did this week, disrupting trade around the world. Oil prices tumbled because most of the Middle East crude goes through the passage. In fact, about $12.5 billion worth of goods goes through the canal, linking the Mediterranean Sea to the Red Sea in Egypt. Basically, it's a shortcut that moves goods much faster than otherwise. My favourite story this week, that's the one about the Bank of Mum and Dad. The Bank of Mum and Dad, and that's exactly what you think it is now the 9th biggest mortgage lender in the country, according to an analysis by researcher Digital Finance Analytics. Parents currently give, lend, or underwrite $34 billion in loans for their kids. That's everything you need to know from the last week. Hope you enjoyed it. I'm Sean Aylmer. I'll be back on Monday morning with the Fear and Greed business headlines. I look forward to your company then.